studying your last two. I swim med when they turned in. The staring down to mute. And can learn the pole that sunk he died.
When a corporation has experienced losses in previous years and then becomes profitable, those earlier losses may become very valuable. Instead of paying tax on the full amount of the current year's profit, the corporation may be able to apply eligible prior year losses to reduce its current year taxable income. This is one of the most common ways Schedule 4 is used in practice. Let's look at a simple example. Suppose that in year 1, the corporation had a difficult year and incurred a tax loss. Since there was no taxable income, there was no immediate tax benefit. However, the loss was not wasted. Instead, the eligible loss was recorded on Schedule 4 and carried forward for future use. Now imagine that in year 2, the corporation's business improves and it earns a profit. Before calculating the current year's corporate income tax, the tax preparer reviews Schedule 4 to see whether any prior year losses are available. If eligible losses are available, they can be applied against the current year's taxable income. As the prior year loss is applied, the corporation's taxable income decreases. And because taxable income is lower, the amount of corporate income tax payable is also reduced. This creates a direct tax saving for the corporation. Think of the process as a simple sequence. First, the corporation incurs a loss in an earlier year. That loss is recorded and tracked on Schedule 4. Later, when the corporation earns a profit, Schedule 4 is reviewed. Eligible prior year losses are then applied to reduce the current year's taxable income. Finally, the corporation pays tax only on the remaining taxable income after the loss has been applied. One important point to remember is that Schedule 4 is not simply a historical record. It is an active tax planning tool that helps ensure valuable prior year losses are not forgotten when a corporation becomes profitable again. Without reviewing Schedule 4, a corporation could accidentally pay more tax than necessary simply because available losses were overlooked. The key idea is simple. Prior year tax losses can become valuable deductions when the corporation returns to profitability. By applying eligible carried forward losses against current year taxable income, the corporation can reduce its tax burden while Schedule 4 keeps track of the remaining available loss balance. This is why reviewing Schedule 4 is a standard step whenever a corporation reports taxable income after experiencing losses in previous years. It ensures that every available tax benefit is considered before the T2 return is finalized. The process of applying prior year losses to the current year's profit follows a logical sequence. Once you understand these steps, you'll see why reviewing Schedule 4 is such an important part of preparing a corporate tax return. The first step is to calculate the corporation's current year taxable income. Before any prior year losses are applied, you need to know how much taxable income the corporation has earned during the current taxation year. Next, review Schedule 4. This schedule contains the corporation's available loss balances from previous years. It tells you whether any eligible losses remain available to reduce the current year's taxable income. After reviewing Schedule 4, verify the available loss balance. Confirm that the losses are still eligible to be used and that the remaining balance agrees with prior year tax records and working papers. Now comes an important decision. Determine how much of the available prior year loss should be applied during the current year. In many situations, the corporation may apply enough of the loss to reduce taxable income significantly, while in other cases, it may choose to preserve part of the loss for future years as part of its overall tax planning strategy. Once the amount has been determined, apply the eligible prior year loss against the corporation's current year taxable income. As the loss is applied, the taxable income decreases, and because taxable income is lower, the corporation's income tax payable is also reduced. After applying the loss, don't forget the final step: update Schedule 4. Record the amount of loss used during the current year and calculate the remaining balance that will continue to be available in future taxation years. Now compare the two possible situations. If the corporation has no available prior year losses, it pays tax on its full taxable income. However, if eligible prior year losses are available and applied correctly, the taxable income is reduced, resulting in a lower corporate income tax liability. This illustrates why prior year losses are valuable tax assets. They help reduce taxes in profitable years and ensure that the corporation receives the benefit of losses incurred in earlier years. One of the most common mistakes made by beginners is forgetting to review Schedule 4 before calculating the corporation's income tax. If available losses are overlooked, the corporation could end up paying more tax than necessary. The key idea is easy to remember. Before calculating the current year's corporate income tax, always review Schedule 4 for available prior year losses. Apply eligible losses carefully, reduce taxable income appropriately, update the remaining balance, and maintain accurate records for future taxation years. Following this workflow helps ensure that every available loss is considered, Schedule 4 remains accurate, and the corporation receives the full tax benefit of its prior year losses under the Income Tax Act. Before applying prior year losses to the current year's taxable income, every tax preparer should follow a consistent review process. This helps ensure that the corporation claims the correct amount of available losses, pays only the tax it actually owes, and maintains accurate records for future years. The review begins by confirming that the corporation has current year taxable income. If the corporation is profitable this year, it's time to determine whether any prior year tax losses are available to reduce that income. The next step is to review Schedule 4. This schedule keeps track of the corporation's loss carry-forward balances from previous years. Before calculating the final tax liability, always check whether any eligible losses remain available. Once you've reviewed Schedule 4, verify the available loss balance. Compare the information with prior year T2 returns and supporting working papers to make sure the remaining balance is accurate and still eligible to be used. Now comes an important planning decision. Determine how much of the available loss should be applied this year. In some situations, applying the full amount may be appropriate. In other situations, the corporation may choose to apply only part of the available loss and preserve the remaining balance for future taxation years. After deciding on the amount, apply the eligible loss to reduce the corporation's current year taxable income. As taxable income decreases, the corporation's income tax payable is also reduced. Once the loss has been applied, update Schedule 4 to record both the amount used during the current year and the remaining balance that will continue to be available in future years. Finally, complete the T2 return using the updated taxable income and the revised Schedule 4 information. As you work through this process, ask yourself several practical questions. What is the corporation's current year taxable income? Does Schedule 4 show any available prior year losses? Are those losses still eligible to be applied? How much of the available balance should be used this year? What balance will remain after the claim? Has Schedule 4 been updated correctly? And how will today's decision affect future tax planning? To answer these questions, you'll typically review the current year T2 return, prior year T2 returns, Schedule 4, the corporation's financial statements, tax working papers, the general ledger, and your supporting calculations. The most important habit to develop is reviewing Schedule 4 before calculating corporate income tax. This simple step ensures that valuable prior year losses are not overlooked, and that the corporation receives every tax benefit available under the Income Tax Act. The key rule is easy to remember. Before calculating current year corporate income tax, always review Schedule 4 for available prior year losses. Apply eligible losses carefully, reduce taxable income appropriately, update the remaining balance, and maintain accurate records for future taxation years. Following this review process helps produce accurate T2 returns, prevents unnecessary tax payments, and ensures that every available corporate tax loss is managed properly from one taxation year to the next.